Hi, in this video, we will be talking about market cap funds. Market capitalization fund is a type of fund which is categorized on the basis of the market cap or size of the companies that they invest in. Market cap is calculated by multiplying the number of shares outstanding with the current market price of one share. As per SEBI guidelines, companies are categorized on the basis of their market capitalization in three types: large cap companies, mid cap companies, and small cap companies. Large cap companies are the top 100 companies in terms of market capitalization. They are the 100 largest companies in terms of their market size. Mid cap companies are those that come between the top 101st to the 250th position. Small cap companies are all the remaining companies that come below the 251st position. Depending on the market cap, SEBI has classified every equity fund into three types, each catering to different risk appetites. Now let's understand each one of these fund types. First is the large cap fund. As the name suggests, this fund invests most of its capital in large cap companies. As per SEBI guidelines, at least 80% of its total assets should be invested in large cap companies. Next is the mid cap fund. SEBI defines it as a fund which invests at least 80% of its total assets in mid cap companies. Similarly, a small cap fund invests at least 80% of its total assets in small cap companies. While these are the three major types, the mutual fund industry has introduced various other types of market cap funds. These provide investors with the benefit of exposure to multiple market caps. There are two major types of schemes we will be focusing on: large mid-cap funds and multi-cap funds. In large and mid-cap funds, at least 35% of the total assets of the fund is invested in large cap companies, and another 35% of the total assets are invested in mid-cap companies. So 70% of the fund should be invested in a combination of large and mid-cap companies. Coming to multi-cap funds. A multi-cap fund should be investing at least 65% of its total assets in equities. They are a mix of large, mid, and small cap companies. Each fund is unique and comes with its own advantages and disadvantages. For instance, large cap funds are of low risk with low returns, while small cap funds offer high risks with chances of higher returns. Since these funds invest majorly in stocks, one should remember to invest in these funds only if they have a moderate to high risk appetite. Each type of market cap fund can be used to fulfill different financial goals. A smart investor should see how each type of fund can help them achieve their respective goals before investing. Thank you for watching the video.